Welcome to Group 5's presentation on the 3M Company. Here's a brief overview of the topics we will cover today, and we will start with background information. 3M's mission is to apply science to improve life and help solve the world's toughest challenges. Below you can see some key players in the conglomerate industry. It is notable that GE fell and Danaher rose above it, a medical technology firm. This indicates the direction of the industry. And to the right, you can see recent volatility of 3M stock price.
As a conglomerate, 3M has many brands, including Post-it, Scotch-Brite, Nextcare, Scotch, Command, and ACE brand. As the regional revenue streams graph, the United States and China accounted for nearly 23 out of $32 billion of 3M sales in 2019.
The first division would be adhesives and sealants. These items include command strips, metal bonders, and such. Next, we discuss surgical appliances. This includes ACE bandages, medical face masks, and clippers. The next division would be hand tools, which includes various items that we can find at any hardware store. Lastly, there are stationary appliances and notebooks. 3M is well known for selling office supplies such as Scotch tape, Post-its, and pads of paper. The pie chart on the right shows each division's contribution to total revenue. It is apparent that adhesives and sealants are the company's main source of revenue at $15.42 billion a year.
In 2020, 3M began implementing a new global operating model. They focused on streamlining and improving operations. They are continuing to transform how they operate and claim to be building a more customer-driven and streamlined organization for the future. In 2019, 3M paid $6.7 billion to acquire Acelity, a leading global medical technology firm. In March, they announced they were working with Ford to rapidly combine complementary capabilities and resources to help meet a surge in demand for personal protective equipment due to COVID-19. In April, they announced they would be providing the White House 167 million respirators over the next 3 months to support healthcare workers.
3M's revenue has increased a steady 6.15% over the past 5 years. This is relatively good compared to competitors. Fellow giants like General Electric and Honeywell witnessed considerable declines. Currently, a lot is happening in the industrial conglomerates industry. The COVID-19 outbreak has had many implications for these conglomerates. There has been an extreme demand shock for the N95 mask and cleaning products due to this pandemic. And then there have been a few deals, as previously mentioned. 3M has teamed up with Ford and the federal government to meet the demands of the healthcare industry amidst the outbreak. 3M's strengths include diversity of industries and having a large global presence. Their wide variety of industries increases their customer reach and provides many revenue streams. Although 3M's diversity provides them many benefits, it also creates weaknesses. As a result of offering so many products, the company is not known as an area-specific expert. It also results in an increased number of competitors of a wide variety. As the world economy becomes increasingly connected, 3M will have more opportunities to expand globally. Threats to 3M include the large number of competitors that are spread out across multiple industries. It will be hard for them to keep up with area-specific experts as well as fellow conglomerates with equally as powerful investment ability. 3M is at risk in regard to the availability of substitutes. They charge a premium for their high-quality products, which inherently puts them at risk of failing against cheaper alternatives. In regards to competition, 3M faces high intensity. There are many area-specific experts as well as powerful conglomerates such as General Electric and Honeywell to worry about. After conducting research, we found that 3M's current price-to-equity ratio was too high, indicating that the stock was overvalued. We also noticed an industrial trend that all PE ratios are declining. We expect this to happen to 3M soon as their stock will likely fall. The chart on the upper right shows how 3M's price-to-book value compares amongst its competitors in 2019 and currently in 2020. The chart underneath shows how 3M's expected value compares with its current value. 3M's price-to-book value indicated that the stock was overvalued. After calculations, we found its current value was higher than the expected value. Also, it was considerably larger than its competitors. 3M's price-to-sales ratio indicated that the stock was overvalued once again. After calculations, the current value was higher than the expected value. It was also considerably higher than most of its competitors.
3M's current and quick ratio saw a steep decline in 2019 as liquid assets were used to acquire Acelity for over $6 billion. It will be important to watch these ratios in coming years. Also notable was the volatility of 3M's return on equity. After analyzing their 10K, we noticed that debt payments spiked last year and will remain high but stable in years to come. Compared to competitor Honeywell, 3M is doing quite well. They have led in most every major category recently, but this past year, they had lower, quick, and net profit ratios. This shows that 3M is having difficulties maintaining superior performance. Relative to the conglomerate industry, 3M has been and remains dominant. However, as we just saw, 3M has some alarming declines in performance that it will need to fix.
Health pandemics such as the one we are currently experiencing have shown to help 3M as they have emerged as a leader in production of healthcare materials. This is evidenced by a comparatively lesser blow to stock price relative to the S&P 500. Also, as previously mentioned, USA and China accounted for over 70% of 3M's revenue in 2019. So the Chinese and American economies fuel 3M's performance. Its beta coefficient of 1.19 indicates that it has above average sensitivity to economic booms and busts. Industry trends also impact the company's stock price performance. As 3M increases its stake in production of healthcare supplies, it should be aware of the outlook of healthcare from the government's perspective. This is an industry with lots of potential regulations.
Recently, 3M stock price has risen up nearly $10 as the demand of personal safety products continues to rise. 3M is a company that has a long history. Its development of quality products and innovation have given way to a wide-reaching and a strong reputation. Also, their dedication to long-term growth has proven to be effective, as can be seen by its stock price performance and overall growth as a company. 3M's financial report shows that its total revenue is below the market expectation, and its organic local currency sales go down to 0.6%. Its EPS is also lower than the previous quarter. The revenue of Safety and Industrial Division and the Transportation and Electronic Division goes down, same as the profits. On the other hand, the Healthcare Division has a massive boost in revenue because of the COVID-19 outbreak was beginning to strike in countries around the world.
Despite recent volatility and shortcomings, 3M has shown over the course of its history that it is a dependable long-term investment. The stock has grown tremendously and paid a dividend that has increased for the past 62 years. There's great reason to believe that the company will use its vast resources to adjust to major changes and continue to be a leader in innovation. That being said, one cannot ignore the recent struggles of 3M. Their stock price has dropped dramatically, and that is why we recommend that investors hold if already invested. We have confidence in the company moving forward, but they are currently experiencing growing pains. After evaluating numerous financial ratios and forecasting their financials for the next 5 years, we concluded that 3M stock is worth approximately $140 a share. We set this as a target for investors. If the stock falls to or below $140, we believe that it is worth investing in the company.